Hello everyone, welcome to module 6 lecture number 1, which is going to accommodate another technique of financial statement analysis, namely funds flow analysis. When you are going to talk about funds flow, essentially we are taking into consideration the balance sheet for a span of 2 years about a body corporate. The simple financial statements for 2 years obviously reflect some changes in different financial items from one year to the other. But mere glimpse at financial statements does not reflect about the causes of such changes in the financial statements pertaining to different financial items. In order to unfold the causes of such changes, it is essential on the part of the stakeholders community to make use of certain techniques which are capable of digging out the changes as well as the causes thereof. Funds flow analysis is catering to analyze and study changes in financial states of affairs of a company between two balance sheet dates. The ICAI in its accounting standard 3 addressed the funds flow statement analysis and its modus operandi of preparing the same by considering the financial statements issued and disclosed by companies over a span of time. To start with, as I said, when you are going to talk about the changes in financial states of affairs between two balance sheet dates, it is very critical on the part of the general users community to dig out and appraise the reasons for such changes. Mostly the changes are going to happen with regard to flow of funds pertaining to different items which are the outcomes of execution of different business transactions during those two balance sheet dates. Now, the funds flow analysis is going to cater to this said area in order to better appraise the changes in financial status between two balance sheet dates. Moving further, it is essential to know the concept on which the funds flow analysis is based on. In other words, when you are going to talk about the concepts, it indirectly talks about the underlying premise on which this particular technique evolved. The fund, when we say in the commercial world, it is a very loosely defined term. Funds can have different meanings to different people. So, it is necessary before getting into the domain of funds flow analysis to specify the concept of funds and the use and application of the same in facilitating an analysis of funds. In the literature of accounting, there prevails three different types of concepts, namely the narrower concept, the broader concept and the popular concept. When you are going to talk about the narrower concept of fund, we only accommodate cash and cash equivalents and all those financial transactions where there is a change in cash and cash equivalent after the execution of the same. Here we do not accommodate those transactions which does not lead to any change with regard to cash and cash equivalents. Then there comes the broader concept. The broader concept of fund accommodates all the items whether it is cash or non-cash in nature. Essentially, when we look at the financial statements and its preparations, it is mostly based on this particular philosophy of fund where we are considering all the items whether there is any change pertaining to cash as a consequence to the execution of the business transaction or not. Here we are there to consider all the items related to a business and different executions of activities which leads to changes in different financial matrices. Then there comes the popular concept which is otherwise leading to the concept of working capital. There is a philosophy which talks about the business transactions which are one way or the other going to have an impact on working capital on a day-to-day basis. It is simply because of the reason that whatever may be the transaction, may it be the payment of different expenses, then may it be the sales revenue activities in the form of sales, anything, purchase of assets, repayment of loans, whatever they may be, either they are going to be executed in cash or through banks. Whatever the modus operandi may be, it is going to have an impact on the working capital. That is why you are going to talk about changes in financial status between two balance sheet dates. It is rather imperative to take into consideration this particular concept of fund and the working capital concept of fund, which is the popular concept of fund, is used as the underlying premise for executing funds flow analysis. Moving further, when you are going to talk about changes in financial status, changes can only be witnessed provided there is flow of fund as a consequence to the execution of business activities, whatever they may be. Now the question arises, what are those transactions which leads to flow of fund? Because when you are going to talk about flow of fund, we are talking about both the facets. We are talking about the inflow of fund as a consequence to different activities. We are talking about the outflow of fund as a consequence to different activities. Now whether it is inflow or outflow, it is essential to dig out the flow of fund pertaining to different transactions. Now say for example, a company has purchased a fixed asset by issuing shares. This is one of the common activity which is getting executed in most of the businesses. But the question remains whether there is flow of fund or not. If you will look at the concept of working capital, which accommodates a bunch of current assets and current liabilities, and the transaction which just I have made a mention of, none of the accounts which are involved in this transaction of purchasing fixed asset by issuing shares are related to current assets or current liabilities. Hence, we may conclude that there is no flow of fund. So there are thousands and lakhs of transactions which are getting executed in a business during a financial year. We cannot dig out the prevalence of flow of fund in this manual way because it is going to take a lot of time. So there must be a logic by using which we are there to know immediately after the execution of a particular business transaction whether there is flow of fund or not. Now in order to do the same, the logic is if the business transaction executed involves a combination of current and non-current accounts, then there is only flow of fund. If the business transaction involves both the accounts which are current in nature, there is no flow of fund. If the transaction involves both the accounts which are non-current in nature, also it does not lead to any flow of fund. Only there should be flow of fund provided the accounts involved in the business transaction leads to a combination of current and non-current accounts. So this is explained with the help of a diagram where we say that the combination of current and non-current leads to flow of fund. Whether it is inflow or outflow, that is a different issue. Before executing funds flow analysis, we are there to appraise whether there is flow of fund or not. Now, for that, the simple logic is this, what I have mentioned just now. Moving further, when you are going to talk about funds flow analysis, it is a systematic approach. And to execute analysis of funds flow, or in other words we may say to dig out the changes in financial position between two balance sheet dates, we are there to adopt a step by step approach systematically in order to arrive at the conclusion and to accomplish the very objective behind the execution of funds flow analysis. Now, as per accounting standard 3, which was prescribed by ICAI, there lies 3 different steps in funds flow analysis. Step 1 leads to schedule of changes in working capital. Step 2 leads to calculation of funds generated or funds lost in operation, and step 3 leads to the preparation of funds flow statement. All these 3 steps are distinct in their orientation, because when you are going to talk about schedule of changes in working capital, we are there to consider and extract all those items which are reflecting current assets and current liabilities in the balance sheets of 2 financial years pertaining to a company. By using the current assets and current liabilities, we are there to prepare the schedule of changes in working capital. We would be discussing the same in subsequent lectures in detail. Then similarly, when you are going to talk about adjusted profit and loss account or the calculation of funds generated or lost in operation, here we are there to adjust all those items, specifically the expenses, the losses, the incomes and gains which are documented in a particular financial year in the financial statements, but does not lead to flow of fund. Say for example, there is a common item of loss which is charged to the financial statement while calculating the profit is depreciation. Depreciation is a book entry. It does not lead to any cash or any fund outflow. But when we are calculating the profit of the business, we are showing it as a loss in the debit side of profit and loss account, which is reducing the profit. So, funds generated from operation simply leads to the adjustment of net profit to all those non-fund and non-operating items which have already been debited or credited while calculating the net profit of the business. Then the final step is the preparation of funds flow statement, where we are going to accommodate all the means through which the funds are mobilized representing inflow of funds and all possible ways in which the fund have been utilized during the financial year. Putting both these things together, we all know that they are bound to be equal, because the simple logic is that if we have 5 rupees in our pocket and we are there going to spend it, we can up to a maximum of spending 5 rupees. If we are there to spend more, we are there to first accumulate additional fund in order to spend additionally what is with us. So, with the same philosophy, the funds flow statement is going to be prepared, and always the sources and application of fund, which are the 2 facets of funds flow statement, are bound to be equal during the particular financial year. Moving further, when you are going to talk about the feasibility of funds flow analysis, essentially we are going to talk about the different means or the significance of funds flow analysis and the way the different stakeholders community are sufficing their objective by using the funds flow as a technique of financial statement analysis. To start with, it facilitates financial statement analysis. Obviously, it is one of the formidable technique which necessitates the analysis of changes in financial position, unlike that of other techniques like ratio, which does not talk about changes in the financial states of affairs between two balanced debts. But this technique specifically accommodates the analysis of changes in financial position between two balanced debts. That is why using funds flow leading to financial statement analysis is going to obviously contribute to the varied objectives of varied stakeholders and users community. Moving further, it explores the confounding issues. When you are going to talk about confounding issues, essentially it leads to an exploration of all those items which are implicit in nature, which are not so explicitly visible in the financial statements, which are disseminated by the business world for use at the end of the users community. And at the same time, the funds flow analysis also explores the relationships which are not so direct so far as different financial matrices which are getting disclosed in financial statements like income statement and balance sheets. So, the knowledge and the exploration of confounding issues contributes significantly to make a deep dive into the financial states of affairs of a company when the said is done backed by the very objective of financial decision making in a rational way. Moving further, it helps in framing financial policy. Obviously, funds flow as a technique of financial statement analysis studies about changes, and such changes are highly vulnerable because changes witnessed in the corporate world on a year-to-year basis is not going to be constant. Rather, it is always going to change with different magnitude and in different directions. And such vulnerability is having a very strong bearing when you are going to talk about financial policies, because policies are more or less targeted towards the near future or the far future. Whether it is the near future or the far future, obviously it is related to a future span of time. Now, by looking at the changes pertaining to the past and present, we can be in a better position to study and evaluate the probable changes that the company is going to experience down the line. So, one of the specific contribution of financial statement analysis using funds flow is that it properly facilitates the users community to make a rational journey into the unknown world of future so far as the corporate world is concerned. The next is unfolding the credit worthiness. Obviously, when you are going to prepare different steps which are involved in funds flow analysis, we are studying the states of financial affair differently for short run as well as for long run. Obviously, when you are going to study separately the movement in working capital or the changes in working capital, the extent and magnitude of the company to generate funds during the financial year, as well as the ways and means of mobilization as well as utilization of funds to execute different business activities, that is indirectly exploring or unfolding the affluence of the business in terms of finance, which we simply know as the financial credit worthiness of the business. Next, it appraises the use of resources. The funds flow statement, which is prepared as the last step, addresses all possible application of funds in different means. Whatever may be the business transaction, may it be interest payment, may it be dividend payment, may it be purchase of fixed assets, may it be anything. The funds flow statement exclusively documents all possible means of utilization of funds. So, obviously, it is going to contribute significantly to ensure whether the funds have been properly or the resources have been properly utilized in the business during a particular financial year or not. The last is it leads to informed financial decisions. Obviously, the stakeholders community, say for example the analysts, the investors, the financial providers, say banks, financial institutions, they are executing financial analysis backed by the very objective of taking different financial decisions related to their vested interest. But they are always expected to take such decisions in an informed and rational way without having any prejudice or any hunch which makes the decisions biased. So, funds flow analysis restricts the users community to execute financial decisions backed by hunches, prejudice or desires, because funds flow analysis scientifically serves that purpose. So, there is no need at the end of the users community to enter into a biased orientation. Next is limitations of funds flow analysis. When you are going to talk about limitations, essentially we are going to talk about the impediments to funds flow analysis as a technique which is used to dig out the financial states of affairs and its changes during different financial years. The first limitation is it ignores timing of funds flow. Indirectly it talks about the time value of money, because say for example the most common activity of inflow of fund is through sales. Revenue is coming into the business or fund is coming into the business. But the quantum of sales in the month of April, the quantum of sales in the month of May and subsequently month of September, December, March, they are equitably treated without paying heed or attention to the timing at which they were collected or they were entering into the business. But we all know that the timing and the value associated with such different timings have a very strong bearing when we are going to talk about financial decisions. So, it is imperative on the part of the users community to adopt and make use of tools and techniques exclusively which are going to accommodate such things. Otherwise, the ignorance to timing of flow of fund is going to have a severe bearing on the decision making executed at the end of the users community. Moving further, when you are going to talk about funds flow analysis, there is every possibility for window dressing. The simple reason is that the financial statements disseminated by the corporate world are falling easy prey to misrepresentation, deceptive disclosure or the act of window dressing. which is leading to intentional distortion and manipulation. Over and above all these things, when you are going to make use of financial statements and its information as inputs for the purpose of executing funds flow analysis and digging out changes in the financial states of affairs between two balance sheet dates, obviously all those impediments emanating from these acts of window dressing is going to remain with the funds flow analysis also. So, it is said one of the fundamental limitation of funds flow analysis is falling easy prey to the act of window dressing, which are imbibed in the preparation of financial statements, and the funds flow analysis makes use of financial statements as the raw document to execute an analysis of changes. Then the third limitation is conditional upon balance sheet disclosures. As I said just before, the companies are resorting to deceptive disclosures, and to a certain extent they are also practicing selective disclosures. No company would like to disclose those things in their balance sheet which are going to be unfavorable to them or which are going to influence their financial states of affairs unfavorably or negatively in the eyes of the users community or the stakeholders community. So, they normally suppress all those financial informations and do not disclose the same in the balance sheet, which is prepared at the end of financial year in a mandatory orientation. But as because the funds flow analysis is heavily relying and dependent on balance sheet disclosures, all such things which are diluted in the preparation of balance sheet is going to have an influence on the outcomes of funds flow analysis through the dissemination of changes in different financial matrices or financial items between two balance sheet dates. Then the next and the last limitation is it overlooks funds flow variability. When you are going to talk about the flow of fund, obviously we are executing analysis to read the future of the business, the future of a company in terms of funds inflow and funds outflow. But the variability in funds flow analysis is not taken care of, rather it is not addressed during the preparation of funds flow analysis. But we all know that if the variability or the dispersion associated with funds flow is very high, it is rather very difficult to arrive at a robust conclusion with regard to the changes pertaining to different financial items between two balance sheet dates. So, on a pragmatic orientation, when you are going to talk about a study of changes in financial states of affairs between two balance sheet dates using funds flow analysis, we are there to be very careful, as the users of financial matrices, and when you are into the process of digging out possible changes by using funds flow analysis, we are there to pay sufficient attention to the formidable limitations which more or less makes the application of funds flow analysis as a tool of financial statement analysis subdued to a certain extent. To end off with, when you are going to talk about funds flow analysis as a technique of financial statement analysis, obviously it is going to serve the very purpose at the end of the users community in general and to the specific users like investors, financial analysts in particular, so far as their decision making objective is concerned. Thank you. Thanks a lot for your patient hearing.